The next thing that we want is a business or a bank account whose intrinsic value is going to go up each year. Why? Because Benjamin Graham said many, many years ago, in the short run, the market is a voting machine. But in the long run, the market is a weighing machine. In other words, in the short run, the market is a popularity contest, but in the long run, the market gets it right. Price follows value. So if we're buying businesses whose values are declining, then we're on a hiding to nothing. We'll eventually give away our returns, we'll generate negative returns. What we're interested in is businesses that are cheaper than their value today and their value is going up. The other thing that's important to note is future valuations are estimates. They're based on an estimate of the future return on equity of the company. They're based on an estimate of what the company is going to do with its earnings, whether it's going to reinvest them at that high rate of return or whether it's going to pay them out as dividends and give them to us, and we'll put them in a bank account and hopefully get 5 or 6%. So we don't know, we can't be 100% certain what the company's going to do. And that's why Warren Buffett, if you've ever read about Warren Buffett, talks about focusing on businesses that are stable and predictable rather than fast-changing businesses. Fast-changing businesses are difficult to get a bead on what the return on equity is going to be and what the competitive landscape for that business is going to be. Okay, and then the last thing, but certainly not the least important, is we look for strong cash flow. It's all very well finding a business that generates a profit that's reported by the accountants as a profit, Qantas is an example, but a business that generates negative cash flow is not a good business to invest in. Okay, here is an A1 business. This is a company called ARB. Peter Switzer often refers to it when I'm on TV. He says, what sort of company do you like? And I say, Pete, ARB, and we both look at each other, we say, bloke stock. The reason it's a bloke stock is because they make four-wheel drive parts and accessories. ARB does a great job of selling this equipment. In fact, it's the biggest manufacturer of bull bars in the world. And it's an Australian company. So you can see this business has a consistent record of being high quality. A1, A2, pretty much all the way back except for 2005. Contrast that to Lendlease. Lendlease has a very different picture. And all this, remember, none of this, there's no human intervention in these charts. We're looking for a business with a consistent record of being a great performer, so 1s and 2s down the bottom, and we're looking for a business that is consistently high quality in terms of its balance sheet strength and a bunch of other things. This is a really, really important thing I'd like to explain to you. This screen, this particular screen that I've got in front of you, I think is one of the most important screens in Skaffold. There's a patent pending on it, there's nothing in the world like it, and it's produced for every single listed company. Okay, and it's also, this is a really exciting thing I'd like to share with you. Skaffold actually converts that chart into natural English. So there's a paragraph above this that you can't see, and it just tells you what you're looking at in plain English. So you can just read that and it tells you what you're looking at. But let me show you what we're looking at. This is a screen of the relationship between Qantas and its shareholders over the last 10 years. The red bars that you can see represent the debt that Qantas has each year. The grey bars represent the equity that owners have contributed to the company. It's how much money you've put into that company to keep it running. The blue line that you can see is the return on equity of Qantas, and the green line is the profit. Now, if we go back 10 years to 2002, I want you to imagine for a moment you don't invest in the share market at all. You are the sole owner. You are the sole owner of Qantas, and I run it for you. You own Qantas. So 10 years ago, well, imagine 10 years ago we started the business, and you put in equity of $4.2 billion. You can see that over on the left-hand side. You put in equity of $4.2 billion, and I suggested that as the manager of the business that we might need some more money to make it competitive. So we'll go down the bank together and we'll borrow $4.4 billion. And that's reflected in that bar. You can see there's $4.4 billion of debt, that red column, and there's $4.2 billion of equity that you've contributed. That's the equity you've put in. Okay? And we're going to run the business. And we run it for a year. And at the end of that year, I report back to you a profit of $439 million, $439.7 million. Putting aside the fact that that's an accounting construct, that profit, for the reasons I've already explained, that's what I report to you. Now, are you happy with that or not? Well, some of you are, some of you aren't. It's an 11.4% return on the equity that you've contributed for the year. So some of you are encouraged to continue to let me run the business. So I'll continue to run the business for you for another decade, 10 years, to this year here. Now you've earned $307 million. It's less than you were earning 10 years ago. Is that good or bad? Okay, so it's not a very scientific process to actually deduce whether or not this is good or bad. There's not a lot of ratios that you need to work out here. So that's bad. What if I then told you on top of profit being lower than it was 10 years ago, you've tipped in another $1.7 billion. Now you've put in more money to earn less. And look at the debt. The debt's now $6 billion as well. So thinking about Warren Buffett's quote, would you be happy to own the whole business for 10 years? Yes or no? Okay, very good. That was very exciting, wasn't it? Imagine this chart for every single listed company updated automatically every time the company makes an announcement. That's really, really powerful. Now that we've talked about quality businesses and what to look for, high rates of return on equity, little or no debt, great cash flow, a business that when you look at it over a 10-year window or a 5-year window even, tells you that you'd want to own the whole business for 10 years, not like Qantas. Then you come to the step of value. Then we have a look and decide whether or not the business is cheap. So we're interested in finding out whether or not there's a margin of safety embedded in the share price. If we can combine those two things, great quality with a really attractive share price compared to intrinsic value, if we combine those two things, then I think we're going to reduce the risk massively of what I call a permanent capital loss. And we also reduce the risk of the share price falling and staying down, because we're buying a business at a discount to its intrinsic value, and we're buying a business whose intrinsic value is going up. If we do all those things, we can't mitigate all risks, but we can reduce them a lot. If you build a portfolio of wonderful companies whose earnings are going to rise over the years and whose intrinsic values rise over the years, and you buy them at a rational price, a discount to intrinsic value, then I think over time your portfolio can't help but beat the index. And I say that with a little bit of confidence because the index is also invested in rubbish. The ASX 200, or the All Ordinaries Index, the businesses that are in it because they're big. They're not in it because they're good. They're in it because they're big. If you can build a portfolio of good businesses as opposed to big businesses, you should be able to beat that index. So here's ARB. This is a sort of business we're after. Notice that this company's intrinsic value is rising pretty much every year. Pretty much every year. And remember Benjamin Graham's quote? Remember that quote? In the short run, the market is a voting machine. In the short run, it's a popularity contest. Stocks go up because they're popular, stocks go down because they're unpopular. But in the long run, the market is a weighing machine. In the long run, price tends to follow intrinsic value. It tends to track the performance of the underlying business. That's the kind of thing we're looking for. If we could buy ARB, if it fell 10 or 15% from current levels, then we would be interested in buying shares in ARB. All right, so let's have a look now at whether or not there are any companies that are cheap in the marketplace. So we're going to take the universe of Australian stocks on the Australian market. We're going to look at A1s and A2 businesses. I've ticked A1 and A2. We're looking at every size company from large cap, mid cap, small cap, down to micro cap and nano caps. We're looking at every sector, and we're looking for companies that are trading at a discount to intrinsic value of 21% or more. That's the universe, the new universe of stocks that we look at. On this table, what I've done is I've selected all the companies in that universe that have little or no debt. So in fact, they've got net cash. I've then selected companies that have positive earnings per share growth. I then looked at companies that have return on equity of above 20%. And I've also looked for companies whose intrinsic value is growing in the future. And this is the list, out of 2,000 odd companies that are listed, this is a list of companies that meet that. All A1s and A2s. They've all got a safety margin there, estimated of course. You'll need to go and do more research. Their dividend yield is there as well for you. Market capitalisation is there. There's their return on equity. You can see they're all return on equities of greater than 20%. And their forecast Oh, you can see that except for, Northern Star and Kingrose. They're all rising intrinsic value. Ladies and gentlemen, I really enjoyed your company today. I hope you got something out of today's presentation.